Hey, welcome to the podcast, everybody. Thanks for joining me. Happy New Year to you. For those that are new to the podcast, welcome. We try to do one as often as possible, but sometimes other things get in the way, like my day job, which is managing money for other people. But I use this podcast to communicate to those that want to learn more and those that have known me for a long time and just want to get my current thoughts on the markets. And so we start out a fresh new 2012. 2011, of course, ended with really the way it began. Volatility, some uncertainty, some gains, some losses, some confusion. And it's really amazing when you look back at 2011, some of the things that did happen, and yet the markets were, depending on which markets you looked at, some were up a little bit. Most were flat to down a little bit. Of course, China was down quite a bit. Gold was up. The euro was down. It was a wild year. But what was amazing to me, what stuck out, was when you look at guys like Bill Gross, PIMCO Total Return Fund, the largest bondholder in the world, PIMCO, they saw net outflows last year for the first time ever in their fund because the returns weren't there because they shorted treasuries, made a big bet on interest rates going up, and they never went up. And then you look at people like Bruce Berkowitz, the Fairholme fund manager. I think he was manager of the decade from 2000 to 2010, down 30-some-odd%. John Paulson, the big hedge fund manager, down over 50% in his flagship hedge fund. So just an amazing year for guys that were had great track records. Just got killed last year, and it was a tough year. It was a very hard year at various times, and last year was about trying to protect the downside because there was so much volatility, and it became a situation where people felt really frozen because they didn't want to lose any money, but yet how do you make money when you're trying not to lose money? It's kind of like sometimes the prevent defense. They always say that it prevents you from winning the game sometimes, and I think that's what a lot of people did in 2011. But here we are in 2012. Nothing has changed. Of course, the calendar has flipped. All the predictions will come out this year. I don't do predictions because I don't find them very relevant. I've never done a whole basket of predictions and kind of graded myself. Maybe I'd be 50%. I don't know. What I try to do is just look at the market and take what it's giving us. I don't know where the market will be 6 months from now. And for those that try to say, well, it's going to end the year at this level, there's no way unless you just get lucky because everything is so fluid and changes so much, and there's so much volatility nowadays. So I don't do that. One thing that we do know for this coming up year is we know that the Fed is going to keep interest rates low, right? And probably long interest rates will stay low as well. Could they pop up? They could, but the Fed's going to keep interest rates low. So we're probably still in a very low-rate environment that keeps things like income-producing assets. This is kind of the right place. Corporate bonds, things like that should do fine this year. Anyways, here we are in 2012. The stock market, of course, had a good day yesterday, and there was a rotation, which wasn't a huge surprise to see a rotation out of the winners from the fourth quarter of last year into some of the losers, right? We saw things like Verizon got downgraded. Altria was down. The utilities were down. A lot of those types of stocks, McDonald's was down. And what went up yesterday? Were things like coal, materials, all the things that got really beaten up in 2011. Because really 2011 was about positioning yourself for an economy that was going to be slow, if not in a recession. And I still think that's the way to be positioned. I think you do need to be careful about being too tied to consumer staples and things like that because you don't want to own too many of those types of things only to see rallies in some of the consumer cyclicals. However, as a big-term, long-term thesis, am I going long a bunch of industrials and cyclical type names? No, I'm not, because this is still a market that, despite what's going on right now, and you see the market kind of hanging in there, seems to be okay. What's wrong? What's everybody complaining about? The underlying internals of this market are getting weaker and weaker. And the only time that I can think that was very similar to this was 2000 2007. And I'll show you that picture in just a minute. But first, Dow Jones up 21 points for the day. Transports were up. You can see the utilities down again today. S&P 500 was flat. And, it was really a mixed bag all the way through. Financials were down after having a good day yesterday. So just a mixed bag of things. And, of course, you can see the Russell 2000 was the worst, down almost 0.2%. So you got this, again, not a bad day considering what was happening yesterday, but it's again, look underneath the surface. And a lot of you may not have the ability to do that or don't have the time, the knowledge, whatever it might be, but it's extremely important to do that because so many of you that are listening now were listening in 2007, and at that point I was discussing the fact that we had a weak economy, we had a weak underlying stock market, and yet the Dow was making new highs, right? And it was a very frustrating time because it kept going up, and then finally when it rolled over, it went down, and it went down very hard. As Al Davis of the Raiders would say, they must go down, and they must go down hard. And that's what the stock market did. Now, I'm not predicting a 2008 scenario necessarily. I do think you need to be prepared for it, and that's different. It doesn't mean we run out there and sell everything, but be prepared for it because we don't know what it's going to be. I just think we're headed for a tough stock market in 2012. Is it going to be a first half, second half scenario? I don't know. All I can tell you right now is there are trades that I'm putting on, but I'm keeping them as trades. They're not long-term investments. I do have some long-term investments, but even those could get sold if things got really nasty. But most of those long-term investments are paying me enough income to where I can wait around for them. However, some of these things that I'm buying now, I'd purchased Starbucks a few weeks ago, took profits on that yesterday. Some of these types of companies that I'm buying are trades, whether they last for a few days or a few weeks or hopefully a few months. But they are trades right now because we're in a tough market. And that's really what I want to talk about is when you get conflicting signals, what do you do? Now, here's a picture of the S&P 500. You're going, that doesn't quite look like today, but looks kind of similar. Well, this is 2006 and 2007. And you remember in 2006, or hopefully remember, I don't know, maybe you don't remember. When you're in this business, you tend to remember years based on how the stock market did. 1999, 2000, 2008. And I remember in 2006, you had this sell-off in the summertime here, and then, of course, it rebounded and up we went. And during that time, a lot of people were saying, hey, this run that we're having is over, and it wasn't over. But the thing was, in 2007, early on, we had this sell-off, and that was early on in 2007, and then it continued to rally up, and everything seemed okay until we got to the summertime and had a really nasty sell-off. You can see the S&P went from about 1,560 down to, 1,400 and so. So, a pretty good sell-off there, and a lot of volatility. These are weekly bars, a lot of volatility. Then it turned around and resumed up, and it was making close to new highs there. And I'm going to kind of fast forward in time here. Okay, now I'm not trying to scare you with this, but I want to point out a couple of things because, again, in 2007, the stock market was making new highs, right up in here, making new highs, and yet it was a very, very similar situation to what's going on today. I was discussing, I remember talking about it, doing a radio show back then, saying, hey, this stock market is not as good as people think. And I almost felt like George Bush, with Bill Clinton calling him, George Bush Sr., Bill Clinton calling him, out of touch. Well, how can you say it's not a good market? It's making new highs. The Dow Jones, the S&P 500, making new all-time highs. How can it be a bad market? And yet the economy had already started to weaken. And what was happening was fewer stocks were participating. So what you see is the S&P 500 and the Dow, a few big stocks were kind of leading the way, i.e. McDonald's, right? What's happening now. These stocks were leading the way, and they have a heavy weighting based on their price, based on their market cap. And because of that, these stocks were basically pushing these indices up. Yet a lot of stocks had already been rolling over months in advance. And that's what we started looking at was, boy, there's the number of stocks making new highs is weakening. The volume associated with the new highs is weakening. And sure enough, the stock market then sold off, and of course, we know what happened. Down, down, down. And look, it went from 1550 all the way down to 666. That's a huge drop, and here was the bottom down in here. And that was in March of 09. I'm not saying we're going to have that big of a drop. But I am pointing out a similar scenario where the stock market right now is going up, and we'll go to right now. I'll just zoom in the last, we'll call it the last 6 months or so. And you can see what's happened is the stock market's going up, everything looks fine, and yet underneath the surface, what's happening? There's less stocks participating, and there's the volume is not there. And yes, there was holiday volume the last couple of weeks, but in general, the volume's been getting weaker, and it's not just that overall volume; it's how much upside versus downside volume is there. We want to see stocks going up with a lot of intensity, and just not seeing that. So how do we play these conflicting signals? How do we do we just sit out? You can do that. I know people that are doing that, just saying, I'm just going to sit out. I'm not going to participate. I don't think that's the right answer, and the reason why is because there is money to be made, and there are stocks that are doing really well. But you have to have an exit strategy. So what I'm doing is positioning myself to where, A, I have a lot of income, which I've been talking about for well over a year now, and B, having things that are less volatile, and then C, having some trades in there of some things that may be volatile, but things that I can get in and out of, have some liquidity, and trade around. Because in the short term here, look, it's breaking above its 200-day moving average, and that looks great. And everybody sees that. This is the area that people are looking at right here. It hit up against this, hit up 2 times, 3 times, 4 times, and now it may be breaking through. Hey, this may be the time that it does something. But how much higher can it go? Even the most bullish people may say 1350. Well, that's not a big percentage up from 1277, but it's enough to participate in. But I'm not going to go out there and start buying a bunch of emerging markets and start buying European stocks and start buying a bunch of materials when I still know that China is slowing down. I still know that Europe is probably in a recession, and I still think that there's a high likelihood that we're in a recession. Nobody's talking about the fact that we may be in a recession right now because they keep looking at these numbers like the unemployment rate being at 8%, right? And saying, hey, we added 100,000 jobs last month. What about the 320,000 that walked away and aren't counted in the numbers? And I wrote a blog the other day, and if you haven't seen it, go to carleggers.com, about unemployment, initial jobless claims, all these things. And again, when you start fiddling with the numerators and denominators, the numbers can appear better than they are. They really are. And we have to respect the fact that initial jobless claims are coming down, and that's highly correlated to the stock market. We have to respect the fact that consumer confidence is going in the right direction, and so the stock market's correlated to that. And we have to realize we're in a presidential election year. They're not about to try to disrupt what's going on by starting to raise interest rates or doing something like that. They're trying to make things better, have you be more confident, because they all want to keep their jobs. So we have to perhaps say, well, maybe the stock market doesn't start doing poorly till later in the year. I don't know. All I can tell you is technically it looks pretty good right now, but underneath the surface it doesn't look very good. And those conflicting signals are things we need to recognize, because this is not your buy every dip market. Unless you see fear spike up and you say, hey, I'm going to buy that fear and then I'm going to sell it when it rallies, that's fine. But to go in there and load the boat on a bunch of things you're trying to keep for several months, this just isn't the time to me. I don't think things are healing up the way the media is portraying it. So, again, pick your stocks to buy. I can tell you right now, in the last couple of days, utilities are weak. I wouldn't jump on them just yet. Let those things come in. Pharmaceuticals have been weak. Let those things come in. But what's working right now? a lot of these agricultural stocks, you take a look at something like a CF Holdings, you take a look at something like a Terra Nitrogen, TNH, those are all things that are working very well right now. Mosaic, not so much, not one that I own, but there's a lot of these companies that are going in the right direction, starting to turn the corner, but that area is working, and even people that are bearish on commodities this year are actually bullish on the food space and the agricultural commodity space. So that's an area we're going to want to watch. But there are things that are working, and we need to continue to trade those areas. But again, keep a tight leash on some of them, because this still is a dangerous market, even though it doesn't feel like it. And I want things to heal up and get better. I want to be able to buy and just put it on autopilot. Unfortunately, that's not the kind of environment that we're in. But there are things that are working, and not only that, there are specific stocks that are in their own little bull markets. But what happens is, over time, is if the market starts to roll over, what you're going to eventually see is, eventually everything gets taken down. Right? You remember 2008? The Coca-Colas eventually went down. The McDonald's eventually went down. The Caterpillars, all the stocks that were working so well eventually get pulled down. So there's no place to hide in a true bear market if things get nasty. And that's why, you may say, well, I'm going to own XYZ for the next several years. And don't be typing in XYZ on your computer. I wonder if that's a symbol. XYZ. No, they knew better. But, XYZ stock, right? You may say, well, I'm just going to keep that through thick and thin. Well, those stocks can fall 30, 40, 50% as well. And again, the nice thing about 2008 is it gives us an easy reference point, because it was only 4 years ago. So it wasn't that long ago, and we can look back to see what happened. But I'm not suggesting that 2008 is happening again. But I am suggesting that we could still have a very tough stock market that could turn into a pretty nasty one and really affect your retirement or affect your how long you're planning on working. And that's something we're not doing. So I still think we need to monitor the downside. But for the things that are working, go ahead and buy those. Just have some entry points, have some exit points, and it's still an environment to trade a little bit in here. And again, keep that core income coming in as well. All right, guys, thank you all for the end of the year donations. I'm not a charitable organization, so I don't think you get to write that off, but I thank you anyways to the website on there. There's a little donate button hidden down in there. Also, carleggers.com, that's the site, and you can subscribe for free up at the top right. We also post all the blog stuff on Google+. It's plus Carl Eggers. Twitter throughout the day at Carl Eggers, and there I post not only some of the economic data coming out, what the estimates were, revisions, and things like that. So Twitter's a great place during the day. And then, of course, the money management website is eggerscapital.com as well. All right, folks, have a wonderful evening, and we will talk soon.